I'm just going to have you state your name, your position, and your company.
My name is Joshua Thomas Leonard the First. I'm vertically oriented and president and financial advisor at the Leonard Advisory Group.
Take that, Maurice or Liam, whoever is editing this one.
Try to mix it up.
What
Make
I
it
have
fun,
to
guys.
deal
Make
with.
it fun.
All right, you're on.
If we look ahead and try to hedge this behavior, in this case, the bad behavior is just taking 0% taxes, right? We need to look out and see if we're going to default to a higher tax position. If so, let's start realizing some of that income sooner than later to level out our taxes. Good tax strategy does not just come when we file the tax return, right? A good tax strategy is looking ahead so we don't have surprises when we file the tax return or missed opportunities. Your tax return isn't just a record of what happened last year, it's a roadmap for what you should do next.
Hello and welcome to the Relax It's Retirement podcast with your host, Josh Leonard, where we talk about transitioning into retirement with intent. I'm Wendy McConnell. Well, hey there, Josh. You make it really hard for me to do the introduction without laughing.
We're bringing joy through the microphone.
I'm supposed to be a professional. You're going to get me in trouble.
You can be part of, any media should be that it's entertaining and bring joy, right?
Well, I don't know if it brings joy to the listeners, but it is to me.
Okay, well, we bring joy. Hopefully they meet us there,
All right. So what do we got going on today?
Well, today we're going to talk about spring cleaning, right? So spring cleaning your taxes. So we're going to cover 3 hidden opportunities in last year's return. So this time of the year, we're hopefully finishing up filing our 2025 or the previous year's taxes. Sometimes that exercise is taking a shoebox to the accountant and he or she turning that into a big stack of papers, right? That we sign off on, and hopefully we don't owe too much money, or sometimes we're joyed by getting a lot of money back. I would say that's probably not the best thing either, right? But we get our taxes done. And many times that stack of paper can tell us an awful lot. In our practice, that's something that we like to run through with all of our clients. When we're looking at taking on new clients, we always want to take a look at the tax return because sometimes it can show inefficiencies, or as we talk through your goals and your strategy, maybe we can find more efficient ways to do things tax-wise.
Okay.
Much like all parts of our lives, it's good to clean things up once in a while. We were talking about automobiles and that kind of stuff prior to our woes with insurance recently, before we jumped on. But I was reminded recently here in Pittsburgh, we got hopefully the finale of snow for the year. And a big thing for me was getting the garage cleaned out in the fall so that we could park cars in there. A little late on that, but with our recent homeowner issues, a water leak that ran through the garage, cars were covered in snow again anyway. So,
Oh, no.
When we do these things, let's try to proof them as much as possible. Now, although I had gotten the garage cleaned out enough to park in there, I was set back now. So as the repairs are done to the home, we'll get everything set up in even a better fashion. Let's think about our tax return the same way. At this point, the game's over, right? We can't change too much, but can we review it and make better decisions moving forward?
All right. Let's get into that review mode.
Let's do it. So the first opportunity that we see is unnecessary capital gains or interest. Many times when we review folks' tax returns that are still working, they might have a taxable investment account that they set up, or it's a trust account. And in that account, they have a variation of stocks, bonds, mutual funds, ETFs, and hopefully that account's growing. But sometimes when we look at the tax return, we can see that it's spinning off a fair amount of income. If we don't need that income to help cover our monthly expenses, it might be an inefficiency in their portfolio. We had one gentleman come in recently that his trust account, this taxable account, was generating about $200,000 in income that he wasn't using. So each and every year, if we think of that in terms of growth, it's nice to get income, But if we're in our high earning years and we're giving 15 or 20% of that back to Uncle Sam, it's not very efficient, right? There's a tax drag on the portfolio there.
Mm-hmm.
That typically happens in a couple different ways. One is through mutual fund distributions. So maybe we bought a mutual fund at the end of 2021 and we held it through the end of 2022. Any gains in that account would be a long-term capital gain. Now, in that scenario, if we think back to 2022, the stock and bond market went down. So if we purchased that mutual fund just at the end of 2021, by the end of 2022, we might have actually lost money in it. When we came to tax time to file for 2023, before April 15th of 2023, we are looking through all that stack of paperwork that we get in the mail, and we see we have a 1099 from that investment that says, hey, we made money. And you think, I didn't sell anything. My account balance went down. How in the world could I possibly have a gain? Well, that can be generated through phantom gains, which is the mutual fund itself selling off some shares. So in that scenario, maybe that fund bought Apple back in 1995, right? And listeners today could probably look nearby and find an Apple-based device, or maybe they're on one listening to this. Apple as a company has grown exponentially over time. So if we own that stock throughout that time period, we'd have a big gain. Now, while you might not have owned that individually, the fund has. And if the fund needs to sell that to cover redemptions or rebalance, you share in that gain. So since it's a mutually held investment, you get the gains even if you don't sell anything. So we refer to these as phantom gains. Those can certainly cause us tax problems, right? We feel like we didn't make any money, but we're still getting a gain. Another one that's similar is dividend income. Sometimes that can come out of dividend-paying stocks. It could come out of mutual funds that have income-based investments too. Again, if we don't need the income, it represents a bit of friction. Even if we're taking those dividends, let's say from a stock, and reinvesting them, we still have to pay taxes along the way. So we want to watch that, right? If we're in retirement, we're using the income, fantastic. If not, does it make sense to hold that in a tax-deferred account, like your IRA or Roth IRA, rather than a taxable account, where we have that tax friction? If it's held in an IRA or Roth IRA, we still get the dividend. Maybe that's a feature of the investment we like, that it's generating income, even if we don't need it today. But let's put it in an account where we're not paying taxes on that continuously.
Question.
Yeah?
I thought that the Roth meant that it wasn't tax deferred, that all the taxes were paid. So
right. So we don't, tax deferred can be anything referring to not having ongoing tax activity. So the Roth and the traditional IRA are different in that we put pre-tax money in to the IRA. It stays tax deferred. We're not paying any taxes throughout the journey. And then upon distribution, we pay taxes. The Roth IRA, we pay taxes up front. We don't pay any taxes along the way. And then when we take the money out, it's tax-free.
Got it.
Our third type of money is taxed sometimes, which we pay taxes on the money, then we invest it. We pay taxes along the way if we have capital gains like we're talking about now, or dividend income. And then if we liquidated the whole account, we'd have whatever's left in those gains or income to pay taxes on as well. So 3 general different types of money. The benefit of owning like that dividend paying stock in an IRA or a Roth IRA is along the way, we don't have any tax impact.
Gotcha.
Another place where where taxable accounts can get us in trouble on our tax return is rebalancing activity. Maybe we set up a model portfolio because we wanted it to kind of operate on its own. And we said, hey, you know what? I want a balanced portfolio. I want 60% of this portfolio in stocks and 40% in bonds. And over time, stocks grow more than bonds. So if we let that just go with the initial allocation, what was initially 60-40 might become 80-20 or 90-10. We might have more risk in the portfolio as those more risky investments grow over time, in this case, stocks. One of the ways we fix that is by rebalancing it. Well, if we have 80 and 20, to get back to 60-40, we got to sell something, right? And that gain will come back to the tax return as well. So we want to watch what type of investments we hold in these taxable accounts. I think questions that we should be asking ourselves when we look at the tax return is, did I actually need that income, right? Do I like the investments, right? If I have a bunch of dividend paying stocks, but I don't have a deep belief in those individual companies, or I don't feel like they give me a strategic advantage, maybe it just makes sense to get them out of the portfolio.
Okay.
Or, like we just talked about, switch it into a different type of account, like an IRA or a Roth IRA. We could hold those those investments in a different account type and be more tax efficient. When we think through building out a taxable portfolio, we always want to keep that tax efficiency in mind. One of the services that we use with clients is our tax management solutions, and that enables us to set a capital gains budget in an account. So if we're worried about specific income thresholds, or if we're in retirement and we're worried about things like IRMA, our increase in Medicare cost based on our total income, we can set parameters around the account to say, hey, we only want to realize this much in gain, or only have this much income generated from the portfolio each and every year. Let's not pay taxes that we don't have to, right? If we can be efficient on that money and still grow it, certainly we don't want to inhibit the growth or the value of those funds going up. But if we can do it with more tax efficiency, that'll put us further ahead.
Okay. I like it.
More ability for compounding, right? If we think of taxes in a taxable portfolio, every time we have to pay a little bit of taxes, that's less money that we get to keep in the account and have it continue to grow. Another big opportunity that we see in retirement is filling up tax brackets early in retirement.
Okay.
Sometimes people will come to see us. Last night, I just taught a taxes in retirement class through our partnership with AFIA, the nonprofit. And in that class, I run through an example of Sue. Now, for many folks, they would say, hey, if I get back my tax return and it says I owe $0 in taxes, I won, right? That's what no one wants to pay unless we have to, right?
Of course not.
Well, Sue's story is a little bit different. Sue came to a class last year, and she came into the office and I think was kind of proud to tell me that she had 0% taxes on her federal return, right? She was proud of it. I often draw the parallel that it's like before I go into the dentist, I floss my teeth for like a week before, like it did something for the other 5 months and 3 weeks since I was last there, right? When people come to see us, they're like, yep, I'm going to dress up my finances or whatever subject matter in our finances we're going to talk about. So Sue was really proud to come in. She said, hey, you know what? I retired a little less than a year ago. I'm 63. And at this point, my only income is my Social Security. Social Security was $28,000. Social Security, if that's our only income source, won't be taxable, right? We have a whole equation that's called provisional income. We've talked about on the show in the past, but if that's our only income source, in general, it won't be taxable. Now, Sue was in a position where she had paid off her home. She had a little bit of money in savings too, like checking savings that she could access if she had a deductible on her car insurance or homeowner's insurance, right? This emergency bucket money. So she was in good shape. Part of that $28,000 ability was her house was paid off, right? Then Sue shared with us a little bit further on in the conversation that at 65, she has a pension from her former employer that she has to take. There's no longer a benefit to deferring that. She doesn't get any more money if she waits, so she's going to take it at 65. That pension was about $70,000. So she was going to default go from a 0% tax bracket up to a 22% tax bracket. She also shared with me that she had saved some money along the way. So if we think through, for us, when we meet a lot of folks, we see common characteristics. People that have paid off their houses prior to retirement, they're able to live on a low, a relatively small amount of annual income, in her case, $28,000, and have earned a pension. They probably had a good paying job at one point, right?
Mm-hmm.
And they probably saved some other money. So she shared that she had about $2 million in her IRA account.
Okay.
And one of the things that we need to be worried about in retirement is our default tax position in the future. And in her case, that $2 million IRA at age 63 is hopefully going to grow, right? She was a pretty aggressive type investor. Her RMDs, or those forced distributions from our IRA accounts or our qualified retirement accounts, starts in her case at age 75. So she's got a 13-year time period. That $2 million could easily become $4 million over that time period.
Sure.
Her required minimum distribution on that $4 million would be about $160,000 a year. This is a lady that only needs $28,000, right? We threw 70 and then 160. She goes from 0 to 32 in her tax brackets by default.
Wow.
So sometimes that 0% tax bracket is actually just us avoiding a bigger problem in the future. Now, if we don't have any savings or we're not working, this, that, and the other, okay, then maybe it's fine. But in Sue's case, it was her just kicking the can down the road. It doesn't make sense for her to not be paying any taxes now. Rather, we want to try to smooth that out over time. In her case, too, she has 2 children. So if that money passes on to the next generation, they also have to pay taxes on that money, right? And maybe when mom passes, her son and daughter are in a later stage of their career where they're earning a fair amount of money. And if they need to take out about $200,000 a year to satisfy the IRS requirements of liquidating the account and taking those minimum distributions, they might be paying even more taxes than mom was. So we need to think through the life of our tax plan and make sure that we're taking advantage of it. For Sue, she had a couple options. One, she could send the money back to Social Security and say, hey, you know what? I'm going to defer this benefit till later. I'm going to live off of some of that IRA money now. In addition to that, she could do things like Roth conversions to try to fill up those tax brackets, right? If we're going to default in a 32% tax bracket, we're in a 0% now. There's a couple stages in between there, right? Depending on how aggressive we be, maybe we want to look at filling up that 12% tax bracket. By doing so, we're able to levelize. For her, we drafted a plan saying, hey, if we take these steps over the next group of years, we can take your effective rate of taxation throughout retirement down by about 10%. That's a pretty significant savings over the life cycle of our funds. So we want to think about that. Looking at those Roth conversions and filling things up before we hit RMD age is often an overlooked strategy in the early years of our retirement.
Yeah. I'd like to be her friend.
Yeah, or beneficiary, right?
Sure, she's very generous with her friends.
Yes. We won't question her generosity, but yeah, it's a good position, right? So we joke, we've talked about this before too. We call that the good saver tax problem, right?
Right.
For Sue, she didn't do anything wrong, right? But going from 0 to 32 seems like that's pretty drastic. Like This is not a lady that's like driving Lamborghinis around or something, right? Like she went to work. I mean, she had a good job, but she wasn't like CEO of ABC Pharmaceuticals or whatever it was, right? Like pretty normal people that just saved, right? And that money compounded over time. And now she's sort of defaulting into a position where it almost feels like we're being penalized by the tax code in the way that we have to take the money back out.
Yeah. So when she said she had paid 0 and she received 0.
Oh, she smiled.
She was so excited. And you were like, no.
Yeah. No, you pay taxes now and every single year. It's a 0% tax return or a 0% tax bracket can often represent missed opportunities. We have one client who is a fantastic saver as well, but she's working part-time early in retirement. And part of her strategy tax-wise is, hey, I want to convert as much as I can into Roth, but since she's working, she can also do a Roth contribution. In her case, what we're doing is we're saying, hey, if you do that Roth contribution, her income's low enough that she's able to qualify for a saver's tax credit. So in her case, her income's under $40,000. She can put money into the Roth IRA and actually get a credit on her tax return. So she's putting the money in, without actually paying taxes on it because she's falling into a 0% tax bracket. She gets a saver's credit for doing so. So we can fill up those tax brackets a little bit more by doing a Roth conversion to get more taxable money over to that tax-free money bucket. So in her case, she's still at 0%, but there's a strategic amount that we're going to fully fill up that 0% tax bracket. And she's been aggressive enough over the years in doing her Roth conversions that her RMDs will not be more than she needs in the future. Sue is in a very different position where she needs to get started on that business now, right, to try to relieve some of that pressure.
Okay.
The third opportunity that we see in reviewing those tax returns and having discussions with clients is how we're giving. So if we're giving money, whether it's faith-based or to local charities or causes that are important to us, let's make sure that we're giving that money efficiently as well. Many folks we meet with are pretty generous, which is awesome to see. Let's make sure that we're being rewarded through the tax code as well, right? Sometimes it doesn't go into tax savings. If we think back to tax reform in 2017, most of us stopped itemizing our tax returns. We stopped saving the receipts for the money we gave to charity, right? It just didn't make sense. The standard deduction was higher than what we would be taking, so we set those receipts aside. Starting in 2026, we have a new opportunity. Now we can save $1,000, or now we can give $1,000 and get that savings on our tax return. So $1,000 per person. So if you're married filing joint, it's $2,000. If you're a single filer, it's only $1,000. So if we're giving money to the church or around the holidays to St. Jude or the Salvation Army, whatever it might be, save those receipts again, because when we go to file in 2027 for this year's tax return, we can take that as an above the line deduction. So we still get the standard deduction. If we're 65 plus, we'd get potentially, depending on income, that new senior deduction as well, $6,000 a piece, plus this $1,000 per filer.
Quick question.
Yeah.
Would Sue, as the $28,000 didn't pay any taxes, would she qualify for the $6,000 deduction?
She would, but she doesn't have any taxable income, so we're deducting against nothing.
Oh yeah. Okay. That makes sense.
Good question, because what we would look at with Sue is, hey, in this tax short-term tax reduction piece that we have now with the senior deduction, is let's take advantage of it, right? That's more money we should be taking out.
At least converting to a Roth or something, right?
Yeah, at least, even if you want to stay in the 0% tax bracket, like we talked through with the other client, there's an opportunity there to find more money to move to tax-free, right?
Yep.
So certainly we don't want to miss those opportunities. For Sue as well, if she is giving money at all, right? Many of us will give little bits of money. I think you can't even go to the grocery store without asking for a donation now. If we're giving those smaller amounts of money throughout the year, if we just track those, again, that $1,000 deduction, if you're already giving that money away, it's just another way to reduce our taxable income, gives us more opportunities for things like Roth conversion.
Okay.
So save your receipts this year. So in 2026, start saving your charitable giving receipts again. We can deduct them. If you're over age 70 and a half, we have an opportunity that we've talked about in the past, and these are qualified charitable distributions. We have the ability to give direct from our IRAs to a charity. As long as it goes direct from the IRA to that charity, we don't pay taxes on that money. In Sue's case, if we think of that $160,000 that she has to be taking out of the IRA, if she chose to be generous and give $10,000 of that to a charity, as long as we do direct from the IRA to the charity, it counts towards the RMD, and we don't have to pay taxes on it. So that's a win-win. Now, in Sue's case, she has 2 kids. She probably doesn't want to give $160,000 away, right?
Her kids don't want her to do that.
Yeah, there's limits to these things. So QCDs are great. If we're turning 70 and a half this year, we get to count our half birthday again. So that's a win, right? Typically we stop around age 10 on that, but you know.
Exactly.
Luckily, the tax code gives us a reason. So at 70 and a half, we can do those QCDs. This is a great opportunity. It's something that we are constantly reminding folks that we're talking to, because once we hit that, hey, you know what? I give a little bit of money to the church. There's these local charities that are important to me that maybe I give $100 here, $100 there. If we set those up as automatic distributions once a year out of the account, we don't have to pay taxes, and that money goes to the place that we want quite easily. We can see that on the tax return. So for me, if I meet someone new that's over age 70 and a half and they tell me that they're giving money to charity and we really haven't been able to deduct it, I can see on the tax return, have they been giving via a QCD or that qualified charitable distribution? In theory, we can give more if we don't have to pay taxes on that money, right? So if we're taking it out of our IRA and then writing a check out to the charity, if we're in the 22% tax bracket, 22% of that withdrawal has got to go to Uncle Sam, right? So if we take out $100, we got to give 22 cents or $22 to Uncle Sam. We're only able to actually give $88 to the charity.
Yeah.
If we do it direct from that QCD direct over, then we can give the full $100. So that's a really powerful ability. We're able to be a little bit more generous there.
Yeah, I like it.
So 3 key things that we need to look at when we review that tax return. Did we pay some unnecessary taxes, right? So is our taxable portfolio generating either those phantom mutual fund gains, there's some rebalancing triggers, or maybe we're just owning the type of investments that are generating unnecessary income? That would be opportunity 1, right? Let's look at the tax return and see if we actually need that income coming in. 2, looking out into the future, right? We talked about Sue. Is there a potential problem lurking in the future? And that 0% tax bracket today isn't going to help us, right? Around Halloween time, it's really great when we get all that candy. And if not enough children come to our house and collect the candy from the bin, the dentist gets an increase in revenue, right? Because we eat too much candy, right?
Not if you start flossing a week before
you got to
go.
floss, but it's perpetual. And I think brushing probably helps more, right? We know these things. These are lessons in life. If we look ahead and try to hedge this behavior, in this case, the bad behavior is just taking 0% taxes, right? We need to look out and see if we're going to default to a higher tax position. If so, let's start realizing some of that income sooner than later to level out our taxes. And the third opportunity is those charitable giving techniques. Let's look at how we're giving money and make sure that we're doing it efficiently. For almost every listener, that $1,000 new above the line deduction will come into play. Even if we just give a little bit of money here or there, save those receipts this year. I think that's an opportunity that a lot of Americans can take advantage of this year.
All right.
Good tax strategy does not just come when we file the tax return, right? A good tax strategy is looking ahead so we don't have surprises when we file the tax return or missed opportunities. So if you filed your tax return now and have a couple questions on it, or maybe got a big tax surprise, we'd be happy to review that with you and look for some of these missed opportunities. You can schedule a 15-minute call with myself or a member of our team in the show notes. And we'd love to look through that, give you some feedback, and see if there's a great way to reduce your taxation or levelize it in retirement.
Gotcha.
Wendy, thanks a lot for joining me today. Look forward to seeing you again soon. And remember, retire with intent so you can live your golden years with the happiness and excitement you deserve.